we'll dive right in with Trevor from Fayetteville for our first question today. And Trevor writes, I was planning to retire in 2024, but I keep hearing that there's going to be a recession this year, and I don't want to run out of money. What should I do? Thanks for your question, Trevor. And talking about the recession, we'll kind of get into that first. So I think the important thing to step off into here is we do hear that a lot right now, in client meeting rooms, or I should say potential clients who are coming in to talk to us. That is a chief concern of, well, I don't really want to make any major moves right now with my investments because I'm unclear about where we're headed in the economy. Because the talk about recession, I mean, we're into now almost 2 full years of a recession is coming, almost like Paul Revere, right?
Yeah. And at what point is that an accurate statement? I mean, it's the old deal of a broken clock is right twice a day.
Yep.
You know, at some point, it will be accurate to have said a recession is coming. Okay, now here it is. Here we are at this point. But the question, I go back to, what is your personal economy? Not the economy, but what is your personal economy, and what impact does that have on your timing for retirement? And Scott, you're dealing in the fastest four this week with economic data. Tell people a little bit about conflicting information there.
Yeah, exactly. You know, you think about it, if you are worried about a recession is coming, a recession is always coming. To Janet's point, we just don't know when. And even the best minds in economics right now, if you read several economists, if you picked the 5 economists that you wanted to read a commentary on today, you're going to get divergent thoughts on if there's going to be a recession, and if so, how bad is it going to be? You mentioned the data, and we talked about that at the top of the show. We got inflation data for the month of June released today as we record the Get Ready for the Future show on July 12th, and we found out inflation year over year in June was, get ready for it, 3%. Now, that's good news.
Yeah,
that is the historical average in the United States, roughly, over a long period of time, the annual inflation rate. But is it good news? Because the Fed has been raising rates, right? We know that. They've been raising interest rates in an effort to cool off demand, which in turn should slow the pace of rising prices. And it's worked. They've been doing it now for more than a year, and we've seen the inflation rate drop from 8% year over year down to 3% year over year. But their target, as they have clearly communicated time and time again, is 2%. Okay, so we're not there yet. And, and they have indicated in many cases since they last met in June and did not raise interest rates, that they were still likely to do it 1 or 2 more times this year. So the battle is won potentially with inflation, but the war is not over when it comes to the economy. And that's why you have this pivot between economists on, are we going to head in a recession? Because you also have earnings. Future earnings are starting to cool. The labor market is starting to cool, but we still have a very low unemployment rate, and we still have good wage growth. So all of these things are fighting against each other, and every piece of data that comes out, it sends the market one way or another. So this unstable market time is just going to be there for a little while. By the way, if you do want to learn more about the economy and the markets, we do a piece every week called The Fastest 4 Minutes in Finance, and you can get that delivered directly to your email inbox by texting the word FAST to the number I gave you at the beginning of the show, 501-381-5228. We're not going to bombard your email inbox with anything other than that video piece. It comes out on Friday morning, okay, and it's always guaranteed to be 4 minutes or less. That's our pledge. It usually comes in around 3. I very rarely get to 4, but we produce that on Wednesdays, and it comes out on Fridays. You can learn a little bit about the markets, a little bit about the economy. But the bottom line here, Janet, is we've kind of given that as the header. Is Trevor is hearing there's going to be a recession. Maybe there's going to be one. Maybe there's not. But when you keep a long-term perspective on when you're going to retire, you can't let a recession dictate when you're going to choose to walk away from work.
Yeah. Trevor, we've looked at this on more of a national and to some degree even a global scale in answering this initially, but I want to circle back to you personally. We don't know what your story is, how ready you are for retirement financially, but the key that we would say in this is to be proactive versus reactive. If you're hearing about a recession and going, I don't want to retire retire. That is a reaction rather than being proactive. And so one of the best ways that we would say for you to be proactive is to plan. And as we put together plans for our pre-retirees to roll into retirement, those plans have built into them the fact that they are ready for a recession at any point. Because the reality is, as Scott has indicated, he's talked about if you were to look at, your random 5 pick of economists that you want to look at and say, what are their thoughts about a recession? You're not going to get 5 of the exact same thoughts. They're going to be divergent in thought. And so we don't really know when a recession is coming. So your plan has to be personalized to you, and it has to have you prepared for a recession at any point. Here's the danger in this rolling of the dice and depending on whether we have a recession or not to determine the success or failure of your retirement. And this is how significant of a deal this is. We're going to talk about 2 people. We will call them Joe and Jane, who had the exact same amount of money when they retired, lots of other things in common. I'll delineate those in just a moment. But the key is that they retired 10 years apart, okay? So they were the same age when they retired, and they both had $500,000 when they retired. They both chose to do a typical 60-40. I say typical. It's not typical at GenWealth, but that's what they did, a typical 60-40 stock versus bond allocation. And they both had the same withdrawal rate, and they both gave themselves the same raises over the years. So Joe retires at age 65 in 1966. And Jane retires also at age 65, but it's in 1976. So the difference here between what they did and what our clients do is that their investments were dependent not upon the plan, but upon what their investment products gave them in terms of a return. There's a key difference between depending on a product and depending on a plan. And so what happens is Joe starts, again, same amount of money, but Joe's rolling along, and at year 81, at age 81, I should say, in 1982, he's completely out of money. And that is because he ran into some slightly negative returns early on. Not even anything really ugly. But because he took a hit early on, then those assets wound up being exhausted by the time he hit age 81. Compare that to Jane. Again, everything else is the same, except that she retired at a time when her early years gave her very positive returns. And so she winds up at age 81, by the way, with $1.2 million, while Joe is broke at that point. Roll on out to age 85, she's actually got $1.7 million. She started with $500,000, and she ends up with $1.7. The challenge that any pre-retiree faces is, realistically speaking, you have no idea whether it's 1966 or 1976. Right. You cannot control that, and it doesn't matter how many economists you study, and it simply does not matter. You cannot determine that. So you have to have a proactive plan in place that will work regardless of whether it is 1966 or 1976, Scott.
These are just actual returns applied in a hypothetical situation that Joe retired in 66, Jane retired in 76, invested the exact same way, and Joe was out of money by age 81, and Jane had $1.2 million at age 81. And I did a little quick math, too. You talked about just mildly negative returns for Joe early on. In the first 7 years, he's actually up 30%. He has 30% cumulative returns, but because he is withdrawing money and gets some negative returns early on, that can crater the portfolio. It can destine it for a zero balance. So the points here, going back to Trevor's question, he doesn't want to run out of money, and he's worried there's going to be a recession. The antidote is to plan. A plan is not an account value, an investment statement, or even just a simple strategy. A plan is a robust and dynamic retirement income plan that shows you how much you can withdraw on a monthly basis, giving yourself raises. But the strategy, at GenWealth, we break this apart into buckets of money so that we can push sequence risk out of the way. right, Janet? Because you can put some money in safer, conservative investments that you are withdrawing today, that you're withdrawing next month, that you're withdrawing in the next year, maybe even several years, before you expose it to market risk.
You mentioned sequence risk. I want to be sure.
Yes.
I mean, we've kind of talked around that, but to define that, it is sequence of return risk is whether you're going to have positive returns or negative returns early in your retirement, and it really can have a tremendous impact on your overall retirement picture if your plan is not built to withstand either the positive or the negative.
Yeah. So I would say to Trevor, to wrap up here, to think about what your income needs and your income desires are in retirement first. Because if you lay that out, your mindset shifts from, do I have enough because my asset level just went down because I may have been invested in the stock market in 2022 and lost 20%, and more toward what kind of income can my portfolio possibly produce, and that only comes through the planning process.
And Trevor, I would add one more thing. At some point, you get to the point where you go, you know what? I'm just really over this whole working thing. Like I'm really ready to be done with it. And I'll say that not just to Trevor, but to anybody out there listening, that when you get to the point that you go, okay, I'm done, frankly, before that, if you can, but it's time to get a plan together, because we have seen too many people work until their last breath, quite literally, simply because they thought they had to. The news on any given day will give you 17 reasons to not retire right now. You've got to look at your picture and decide, when is it important for you to retire, and if you can pull the trigger on that according to your plan, then go ahead.